Welcome, ladies and gentlemen. Our event will begin momentarily. Please note that this session will be recorded for informational, educational, and marketing purposes. Good morning, afternoon, and evening, wherever you are. On behalf of Nanyang Business School, NBS, Principles for Responsible Investment, PRI, and European Corporate Governance Institute, ECGI, I'm delighted to welcome you all to the second lecture of the NBS-PRI-ECGI Public Lecture Series on Sustainable Business. My name is Yusha Zhou, and I'm assistant professor here at Nanyang Business School at NTU in Singapore. I have the privilege of representing the event organizing committee as your MC for today. The NBS-PRI-ECGI Public Lecture Series is a brand new global initiative starting this year in 2025, aiming to facilitate knowledge exchanges among academics, practitioners, and policymakers in the field of sustainable business. Every month, we'll host a public lecture either in person at NBS with live stream via Zoom or, like today, virtually via Zoom. Each lecture will feature a leading scholar to present an overview of academic research with a specific topic in sustainable business for around 60 minutes, followed by a 30-minute Q&A moderated by an industry expert to connect academic insights with practical experience. After each event, we will summarize the content in a blog post, and with the speaker's permission, we will share the blog post together with the recordings online to create a public library on sustainable business for all. We have an exceptional lineup of renowned academics across disciplines, including economics, finance, accounting, strategy, and law, aiming to encourage interdisciplinary dialogues and collaborations to address sustainable business issues with a more holistic perspective. Last month, we launched the series with an inaugural lecture by Professor Starks from University of Texas in Austin on climate risk and financial markets, value versus values perspectives, and is moderated by Dr. Joanne Q, Director of ESG from Eastspring Investments, PRI's largest unitary based in Singapore. If you have missed our inaugural lecture, you are very welcome to check out our online blog and YouTube recordings, which are free to access by all. Today, we will continue this inspiring journey with Professor Pedro Matos. Professor Pedro is the James A. and Stacy Cooper Bicentennial Professor and John G. McFarlane Family Chair in Business Administration at Darden School of Business, University of Virginia. Meanwhile, he currently serves as the Vice Chair of PRI's Academic Network Advisory Committee and has been instrumental in connecting the PRI community with academic research, especially at PRI in-person conferences. Pedro is also a research member at ECGI, making tremendous contributions to our understanding of institutional investors around the world and more recently in sustainable institutional investing. His work has been published in all the top finance academic journals, frequently featured in the press, and received numerous awards. So today, Professor Pedro will deliver to us a public lecture on ESG investing and green transition. So noted that we have a 30-minute Q&A session following the lecture. Therefore, we invite you to pose any questions that you may have on this topic to the Zoom Q&A function to join this dialogue with our speakers. So now, Pedro, please, the virtual floor is yours.
Great. Thank you, Yusha, very much for that introduction. And thanks, NBS-PRI-ECGI for the opportunity. I really appreciate everyone joining us from all over the world. It's early morning here in snowy Virginia, but good afternoon for you in Europe, or good evening for you in Asia. Thanks for everyone for joining. So first, I'd like to suggest audience check out the past webinars, as Yusha mentioned, the first PRI-ECGI NBS lecture was by Laura Starks and covers a lot of the academic research on climate risks. So it's very pertinent to the discussion I'll have today. And I also will be referencing a previous webinar that I did for ECGI. But today, the focus will be on what's new in 2025. So what's the main message of my lecture? So I'll be examining the role of ESG investors or responsible investors, if you use the PRI terminology, in influencing the E dimension of ESG, specifically the green transition. So the movement towards a more sustainable economy. And I'll focus on three main messages. ESG 1.0 is that while many ESG investors align their actions with their principles, there's instances of greenwashing that one should be aware. Number two is even if you have climate conscious investors walking the ESG talk and by doing so greening their portfolios, it is an issue whether they might be helping or not achieve the broader ESG goal of greening the planet. And then the third part, which is the core of the presentation, is some new work I'm doing on the green transition and show that the green economy still is relatively small and leaves the question open whether it can happen quickly enough, this transition. So I'll try to be evidence-based, and ESG is undergoing a lot of shakeout with greenwashing, with hype, but I believe ESG factors are becoming increasingly important tool for investors. And so even though the space is messy, academic inquiry, healthy skepticism can help focus ESG investing in addressing issues like climate change or other environmental challenges, the ones I'll focus on today. But it's always important that I state some disclaimers, which is a lot of what I present today is based on my own research journey with a lot of co-authors, of course. There are many other papers than the ones I'll be citing. So I encourage, again, to check out the great webinars, including the first lecture by Laura Starks, but also the future ones in this series. And also be cautious about ESG competency, greenwashing, including my own. So as Alex Edmonds wisely said, story is not a fact, so it may not be true. Fact is not data, it may not be representative. Data is not evidence, it may not be supportive. And then evidence may not be proof. It may not prove not to be universal. So even if we have strong causation evidence in one setting, it may not apply universally. So it's always good to be skeptical, and that will improve our understanding. So I'm going to start by just fleshing out that ESG has been in news over this last few years. There's no way we can have a full discussion on everything that's happened in this wave, but I would begin with 2021, where lauded as the year of ESG with record inflows, green stocks exuberance, and new regulations coming from the PRI. 2022, ESG is becoming a little bit more controversial. This is from The Economist, the 3 letters that once saved the planet, and some accusations of greenwashing. The Economist argued that it's better to focus solely on E for private ESG initiatives to complement government action. 2023, some slowdown and some outflows. So questions whether inflation and other market corrections with some political pushback or regulatory scrutiny was having an impact. But 2024 has been considerable backlash. For example, who killed the ESG party, a lot of greenwashing or companies talking more about transitional investing rather than ESG investing. And of course, the political changes here in the US. So what's next? There's considerable discussion right now backpedaling on climate alliances. And I won't, go through all this, but just yesterday, the Financial Times had an article saying BlackRock was canceling meetings with companies amid shareholder battles and fearing that it could violate some new SEC guidelines on investor activism. So it's impossible to touch on all these aspects. In the US, this potential withdrawal from the Paris Agreement, diverging the state and federal climate policies here. The regulatory pressure, especially coming from Europe, and some, revisiting of that, or the increasing, but I believe there's still increased private sector role in climate finance. So this is a good, yet a good time to discuss ESG investing. The question is, how does it possibly help the green transition? So what I mean by green transition is we're talking about climate change, which is arguably the more significant components of E in ESG, and the ongoing green transition. So researching this green transition often feels like you live in this state of cognitive dissonance. There are mixed signals, that we're seeing. Reasons to be pessimist would be the world is on track for a temperature rise well above the Paris goal of 1.5 degrees Celsius over pre-industrial levels. Some limited action after COP29 in Baku. The United Nations emission report gap from 2024 highlights some troubling trends. For example, this figure here shows the small dip in emissions that occurred during the COVID lockdowns, but the overall trajectory is, still upwards. On the other hand, there could be reasons to be optimistic. And this is just some article from Wall Street Journal showing the growth in renewables, electrical vehicles, the coal being decommissioned, levelized cost of energies of different renewable coming down, battery storage costs coming down. And this is switching from electrical vehicles to, from combustion engine vehicles to electrical in different markets. And the economists basically showcasing that actually we've exceeded expectations in terms of the ramp up of renewable energy. This is from the IEA, the International Energy Agency. And so you could be very confused right now. There's, somewhat we're exceeding expectations on one side, somewhat we're behind on expectations on the other side. So my lecture outline here is, I'll focus first on the ESG investing, and then I'll turn my attention to the green transition, and then connect the two. So part one will be somewhat an update on that webinar I mentioned that I did for ECGI, but I'll focus on what's new, in 2025, of course. And then part two will be this new research on the green transition, latest findings on this shift towards a sustainable economy. And I'll finish up with some takeaways and open questions for future research. So to start this first part, I'll begin by some background on ESG investing. In that webinar, I mentioned that not all, ESG investors truly walk the ESG talk, particularly here in the US. And this suggests there's some phenomenon of greenwashing, which is a conflict between the commitments this investment managers and asset owners take versus their fulfilling their fiduciary duties, which causes tensions, particularly here in the US. In the second paper, I'll discuss that walking the ESG talk with practice, let's say, more by European and investors from other regions may not result in real impact. So before I dive into these papers, my own journey in this started with a literature review I conducted for the CFA Institute, which is called ESG and Responsible Institutional Investing Around the World. So I won't rehash the definition, the history, or the motivations behind ESG. I'm assuming everyone here is familiar with it. But the question that prompted me to look into ESG was what is the scale of ESG investing? And that answer I came to was it really depended how one measures it. So if you strictly focus on ESG labeled mutual funds, the figure here for Morningstar would be 3 trillion in AUM. That compares to capital markets, so equity plus fixed income markets of 231 trillion. So that's a drop in the bucket, in terms of how much this investors could play. But if one takes a broader lens, the GSIA puts out this estimate, more around 30 trillion. So that would encompass not just mutual funds, but pension funds, insurance, sovereign wealth funds, etc. And if one takes the widest perspective, which would be the NBS-PRI, that has grown from a few signatories in 2006 to several thousand today, and that represents 100 trillion in assets. So that would be a massive, a part of the capital markets being invested according to ESG principles. So despite all the academic research I was reviewing in that CFA literature review, I found that, this adoption of ESG remained somewhat unclear. So I decided to take a look by analyzing some data from the PRI. So the PRI has these principles, the first of which is that you should incorporate ESG into the investment process. The second is you be engaged owner, and number 3, number 4, etc. And perhaps more importantly to me, the most important was number 6, which is the principle that you would report each year on your activities and progress towards implementing the principles. So I examined the 2019 PRI assessment report data as that became available. And of course, the first finding was the European-based institutional investors were leading the pack. These are some of the names. I won't go through all the details here and, break down by regions and all that. But the question was, how do you then implement ESG? And the PRI signatories implement ESG in various ways, or, not just PRI signatories, but basically all starts with stock selection. What assets, how do you build your portfolio? What assets do you buy? And negative or exclusive screening strategies. So in purple here, which is avoiding stocks or investments with controversial sectors like tobacco, arms, grants. Positive screening, also in purple, which is overweighting best-in-class companies, or norms-based approaches, like standards like the UN Global Compact, on focusing on human rights or labor issues. Or having more dedicated strategies in blue, creating those funds that focus on specific themes like renewable energy. Next, you have ESG integration, where asset managers, investment managers, and asset owners incorporate ESG factors into their research, valuation, and portfolio construction. Or alternatively, you don't change the way you invest, but rather you engage with the portfolio companies directly to influence their ESG practices, which is in orange here. This can be done individually. It can be done collaboratively through, for example, the PRI collaboration platform, or through outsourcing and internal voting. Finally, some investors may choose to divest, and I don't have so much data on that. But what did I find? I found, somewhat the negative screening being the most popular approach in purple here, the thematic in blue remaining fairly niche in terms of the percentage of PI signatories using that approach. And a large fraction of PI signatories report high levels of ESG integration and engagement. So green and orange there, but it's hard, of course, to assess their impact. So then I pursue that in a follow-up academic study called Do Responsible Investors Invest Responsibly, which was published in the Review of Finance, co-authored with colleagues here at UVA Darden at the University of Virginia. And the University of Geneva as well. In this paper, we explore whether the signatories of PRI truly walk the ESG talk by integrating ESG into their equity portfolio holdings, or if not, if there's any evidence of greenwashing. So the first question was, how big is which institutional investors commit to PRI? So you see some larger and institutions domicile outside the US picking up faster. Our research then combined data from that PRI survey data I mentioned before with the institutional equity portfolio holdings from FactSet, which is something I'll use in the subsequent work and show you. And then company level ESG scores. And there are many data providers. We took 3 of the most popular ones, MSCI, Asset4 from Refinitiv, and Sustainalytics. And then we use this data to compute a ESG portfolio level score, comparing how sustainable are the stocks in the portfolio of institutions that have signed the PRI versus its peer institutions that have not. And so the question then is, do PRI signatories have better ESG scores, and that's or ESG footprints, and that's what you see in those bell curves, that there's somewhat better stocks or higher ESG scoring stocks in PRI portfolios than non-PRI portfolios. But the result was not the same when we look into US domiciled, where we actually found lower scores than non-PI signatories versus outside the US. So especially outside the US, there's the PI signatories tend to somewhat walk the ESG talk, but there was some evidence of, let's call it, greenwashing. And we discussed why there's differences in commercial and social values here in the US, but also this tension around fiduciary duty in the US. The article was featured in Economist. The title might have been a bit too strong. In any case, my key message is this: it's important to keep a healthy dose of skepticism, and we might be also in the early stages of ESG investing when we did that study, and of course there's been a lot happening since then. Very active literature, academic literature on ESG and potential greenwashing. I just highlight some of the academic evidence here. Some other studies on the PRI, Kim and Jung, looking into US equity mutual funds, Liang, Sun, and Teo, looking at hedge funds, Dimson, Caracas, and Lee, looking at success of coordinating engagements, the colleague Franco and Lynch, looking at voting by ESG versus non-ESG funds on ENS proposals and governance proposals. Yusha herself has some work on this. There are many other papers here on greenwashing or impact washing. Most of the evidence pertains to US mutual funds, but there's some work I list here also on banks, like SBTI commitments, and then potential greenwashing by corporations, and some conflicts of interest as well on the ESG data providers. So where does this leave us? Well, this has evolved to, these issues have arisen, this greenwashing have arisen not just in the US, and there's been some combating of greenwashing, both in terms of standards, voluntary, and regulation. So in terms of voluntary standards, you can think about like stewardship codes and the CFA also having this disclosure standards for investment products. In terms of regulation, the EU can be thought as a leader here, and I'll be talking about the EU taxonomy in a short while. But other initiatives like the CSRD, the Corporate Sustainable Reporting Disclosure, and then the CFDR, Sustainable Finance Disclosure Regulation. Some greenwashing has been, or greenwashing in the first time than greenwashing, has been somewhat replaced by greenwashing. A lot of pullback from talking about this. It could be because of regulatory pressure, but it could also be because of some of the backlash I mentioned before. And we're talking about greenwashing now in 2025. Very quickly go to the second study here, more specifically on not ESG broadly, but climate change with the work on decarbonizing institutional investor portfolios. Again, co-authored with colleagues from Darden and the University of Geneva. This is more work in progress and it's not peer-reviewed publication. So we talked about this. The climate scientists concluded that continued growth in GHG emissions. And so this is a classic case of an externality which would be ideally addressed by global carbon tax, but there's difficult to coordinate globally, despite some agreements like the Paris Accord, to bring down those emissions, as you can see in this picture. So the financial industry is under pressure, and the PI and other initiatives like CDP, formerly Climate Disclosure Project, and the Climate Action 100 Plus that came subsequently, because a lot of financial industry players, in particular institutional investors, they own and control a growing share of the global equity market. And a lot of these companies profit from polluting. In the paper, we examine whether these climate initiatives or climate conscious investors that join these initiatives are decarbonizing their portfolios, and if so, how are they achieving this decarbonization? So one challenge here is that public, as you can see in this picture from The Economist, is that public equities may, of the 50 billion tons of emissions you can see on the top chart there of industrial emissions, 40 to 50 gigatons of CO2 equivalent emissions, only about 10 of the 50 resides in public equities. So that represents only a fifth of the total emissions. And so if you decarbonize your portfolios of those companies, you're just, having an impact on a fraction of the emissions. And so the question is, well, is this significant enough in reducing global emissions effectively? And number two, are they going beyond just reducing emissions, but also supporting the energy transition, which will be part two of my talk with the new research after this one. So there's lots of tests and lots of work in this study, but if you want to take away one punchline, I'd compare the two figures on the left. The bottom figure gives you the institutional share of the market capitalization. So that's growing both by CDP signatory members and by non-CDP members. So that's growing from 40 something to upwards of 50%. So you would expect that the top panel, which is the institutional share of global carbon emissions. So, for example, if an institution owns 1%, let's say BlackRock owns 1% of ExxonMobil, then we would attribute 1% of its emissions. Of that, 30 or 40 big gigatons per year. A lot of the emissions are outside public markets. You can see it's the empty area. Then you see a lot of the other emissions are can be attributed to owners that are not institutional investors. Those are the checked boxes there. And then the last sliver in dark blue and orange, those would be the portion emissions to the institutional investors, the 1% that BlackRock owns, the Norwegian sovereign wealth funds, LGIM, as the institution from our moderator, and so forth. So what we would, a rough estimate would be, if institutional ownership is growing, as we show in the bottom, then a rough estimate would suggest institutions' GHG footprints should have increased proportionally in the top from the 10% or so in the beginning of times to like 15% later. But what you're seeing is it's staying flat. It's actually staying around that 10%. So this indicates active decarbonization. Of course, we do more tests. You can look at other carbon metrics beyond just the one I showed you. And the question is, how are institutional investors, if they're keeping their total carbon footprint stable in a growing market, in a world where emissions are still growing, they must be recomposing their portfolios. And so there's two strategies here. One would be tilting, which is reweighting from brown to green stocks. Or the alternative would be to stay invested in the brown stocks, the higher polluting stocks, and make them less brown over time. That would be engagement. So what we find in the study is that most of the evidence suggests tilting, which is reweighting towards greening your portfolio, but not helping to green the planet, not directly addressing that climate challenge. So it's basically pushing the problem, the brown stocks from your portfolio to some other owners, right? Because the total emissions are still growing, as shown on the left again. Again, there's a very active literature here. I wanted to leave you some references. I will not do justice to all the studies here, and just leave this for those who are interested. On tilting in versus tilting away, which is, I think, the essential debate here, and whether even with tilting away, which we document, whether there are or not cost of capital channels. And there will be, as I said, many other studies here. And we should also look beyond, just equities, as we're doing here, other asset classes. And we also be looking also, aspects like monetary policy and so forth. So there are many, many other initiatives beyond just the ones we examine in this study. So let me then turn to the core of the lecture, which is actually part 2, and share the latest study of how does these two things line up, the ESG investing I talked about and potential greenwashing, where investors may, not exactly invest where they say they do, or the investors who are climate committed, like CDP investors or Climate Action 100 investors, who are actively, tackling carbon emissions in their portfolio, but maybe doing so by greening their portfolio rather than, helping to green the planet. So how does that then speak to the green transition? And this is, again, some recent work with authors here at Darden and the University of Geneva. So the transition to this green, low carbon, resource efficient, sustainable economy has been somewhat slow. And the key questions we try to address in the study is how fast, how big is this green economy so far? And does it have, some jurisdictions like the EU introducing green classification systems like the EU taxonomy? And I'll tell you what that means in a short while. And then do companies that have the technology solutions to take the market to actually make that transition happen? And are investors willing to finance the transition? So for this, we looked at a measure of green revenues, which is going to be, very much aligned with the EU taxonomy's measures, but that was introduced years earlier by FTSE Russell. And it measures the revenue that a company derives from green products and green services. And I'll illustrate some examples later. But the good thing is lets us go all the way back to 2008 and also study, the impacts, for example, of the Paris Accord. So this new measure of green revenues tries to capture this transition to green. And what we show in the studies, it has low correlation with the measures I showed in the last two studies, the measures such as the ESG scores and the measures like carbon footprint, that, where the more common in the literature that I was highlighting before. So question number one, as I suggested, was how big is this green economy? So what you'll see here in the first picture is that the total green revenues as a proportion of total revenues, and that has grown from 4 to over 6% of companies' global revenues. This is from, companies from all over the world that are covered by FTSE. And then it's sliced by this, I should say that the takeoff seems to be there in the year 2026. And that, coincides with the Paris Accord that I mentioned before, COP21. And now the question is, can we understand what are some examples of this revenue streams? So the first one would be in energy. So when we talk about green transition, a lot of it is the energy transition. And also there's more than just the energy transition. But by energy, we mean equipment. So like, wind turbines, solar panels, companies like Vestas, etc. Energy generation. So whether that's, renewable energy, so wind, solar, or hydro, or nuclear, that may be a more controversial one. EDF is shown here. Companies in China, companies in Brazil, in Europe, ENGIE and Enel. In energy management, that is perhaps more, how we're doing this event right here, which is, using, cloud systems, remote, that allows for remote work, etc., AWS, Microsoft Azure, and so forth. So big revenue streams for now the tech companies, but as well as energy management systems like Schneider or E.ON, or energy management, for example, Daikin, which is air conditioning, HVAC systems. On top of the energy transition of, being more carbon light and moving towards a more green energy economy, there's another layer which is part of green, but not necessarily just on the green, on the energy transition, which would be things like, some chemicals, but also some minerals. Well, links back to like, SQM would be lithium, links back to some of the key minerals that we'll need to make that transition happen. A smaller sliver would be sustainable agriculture, forestry, and so forth. Bigger sliver one can think of is transportation. And that's, you talk about like electrical vehicles, your Teslas, BYDs, both, US and China, but also hybrid vehicles, So by this measure, all of Tesla's revenues would be 100% green, because 90-something% of that is the electrical vehicles, the cars. And then the other 7% would be solar panels and the storage, battery storage. But for example, for Toyota, which is highlighted here as well, only the electrical and the hybrid vehicles would be considered green. So that's about 30% of its revenues. And then, there's not, in Mercedes would be a smaller percentage, of course. And then beyond just cars, you also have, rail and other forms of transportation. So that's why you have Alstom here as an example as well. Finally, last two slivers are pollution control and water infrastructure. Of course, there's less companies in the public markets that are pure plays on this. So it's actually hard to come up with, very specific examples here. But what you're seeing is overall, this economy is now about 6.5% of total revenues. And that's about $4 trillion in total. And that would be comparable to the size of the oil and gas sector. Of course, the oil and gas sector size fluctuates with price. Oil prices going up and down, and subsequent to the Ukraine war, we've seen oil prices coming back up. But what this is perhaps showing is the green economy is catching up. Can it be much bigger than this? It's hard to say, because we still don't have solutions on energy, transportation, etc., that are green for to fully drive all the company's revenues. And there are full sectors of the economy that we still don't have solutions to make green. I'll talk about that a little bit later. So here's a different visualization of that same data, but for 2022, where it's a tree map where each box size represents the size of the green revenue. So I gave you the example of Tesla, of Toyota, and so forth, and you can see here examples. What I would maybe change slightly the coloring here, just to give you a sense that not all this green or GRCS FTSE revenue streams are equally associated with environmental benefits. So actually there's a tiering system FTSE uses. Tier 1, which is this dark green, are core products products and services that have significant and clear environmental benefits. So that may be the things we talked about, like in terms of electrical vehicles, or in terms of power storage, or solar equipment, wind turbines, etc. Tier 2, which is more the medium green here, cloud computing, railways, somewhat more controversial, right? What is the energy consumption of those? And are they, maybe they were important in the early stages of the green transition, but as the green transition evolves, this becomes less clear that they have net positive environmental benefits, because there's some costs to this environmental costs to these technologies. And tier 3, which is the light green, those are some that have environmental benefits, but overall are either net neutral or could be even negative. And maybe the core example there would be nuclear, where there's a discussion of whether, and you see here with EDF, it's a large chunk of some utilities energy production, but there are environmental issues and concerns with those technologies. Same goes for mining, for those essential minerals I mentioned before for the transition with lithium, etc. They are essential for the transition, but they could be net neutral or net negative in terms of the environmental impact. So here are the green revenues by country. So what you see here is that US and China dominate, right, in terms of the total green revenues on the left, but they're proportionally higher on the right when you look into European markets. So, some of the largest companies are Tesla, BYD, Azure, so Microsoft, Amazon, all those I mentioned before. But as a proportion of their total revenues, which is on the right, there's actually a bigger penetration of green products and services in the EU listed companies in blue than in the other markets like China and Japan, etc., which is in orange, or US, Canada, which is in red, or other regions of the world like Brazil, Chile, etc., in South Africa in green. So one thought, and we show in the paper, is that a driver of this may have been this EU push towards sustainable finance, sustainable economy, the Green Deal. And in particular, we show in the paper the takeoff that happened after 2018 with the creation of the technical expert group, and 2020 with the implementation of the EU taxonomy for sustainable finance. So the taxonomy, basically, if I go back here, I apologize, it also uses very similar definition of a activities that are green. And the correlation between the measures we use here and the measures of the EU are very, very high. So here are the green revenues by industry. And so as expected, you'd see some sectors where there's a higher penetration of green products and services, and that would be the, utilities, transportation, so consumer durables, some manufacturing sectors as per the examples I gave you before, but they have whole sectors of the economy on the right side of this chart that there's been very little chance, of course, that they can transition, like healthcare or communications, etc. So the second question then we ask in the research paper is, what's driving this transition to green? And the first driver we look into is what internal capabilities of companies. And to look into those, we look into this data that I've compiled with some co-authors here at UVA Darden on the global patents, the patents that are by all companies around the world being patented here in the US PTO, and using a methodology used by other studies like the Cohen and all and Hege and Hege, etc. That look into the green patents. So technologies that help with climate transition and with climate adaptation. So you go through all the patents filed by public companies, and then you parse out those that are in the technology classes that pertain to mitigate or to adapt to climate change. And so what we see is that companies that had those patents years prior to the Paris Accord, so in the years 2008 to 2013 to be more precise, they've actually experienced an increase in green revenues of about 2% post-Paris. And that's shown here just for the academics in the room in this sort of definitive chart. There's some, somewhat parallel trend between companies with green patents and companies without green patents, but then there's a divergence post-Paris, post-2015. Lots of additional results in the study, but I'd highlight one is that this result seems to be concentrated in particular in US companies and that US domiciled companies that are more capable to bring those innovations to market, to actually take those technologies and actually scale to actual products and services in which they grow revenues. Driver number two is we looked at, and that pertains to institutional investors, is what is the support the company might have of institutional investors that are aligned with green initiatives. So that's where we're combining the prior two studies in part one of my lecture with this study, where we look into the PRI signatories, those institutional investors that are signatories to the Principles for Responsible Investment, and also the climate conscious investors by looking at the CDP investors. The reason we look at CDP is CDP, is an initiative that's been around since 0506, but the Climate Action 100 really only started post-Paris. So we wanted to see those institutions that were there already PI members or had also been signatories to CDP pre-Paris, so in the years prior to Paris, if they were owners of a given company, if that allowed the company to scale up their green revenues post-Paris. And that's kind of what this other chart shows you, that there was a takeoff of higher green revenues, about 1% for companies with higher institutional ownership, in particular ownership by responsible investors climate conscious investors, and we also showing some results around long-term focused investors. And we observed and subsequently have higher green revenues. Now there's no perfect empirical strategy here, of course, but this is, suggestive of the kind of importance of investors ESG investors, broadly speaking, in the transition towards green. So maybe for the investors in the room, you might wonder, well, am I getting any returns from the companies that are transitioning, or does this come at the cost to the investors? This transition to green is actually a tax on shareholder value, even though it creates maybe some positive externalities and some better ESG outcomes for society. So the way we do this, answer this question, is we form value-weighted portfolios of green stocks at different thresholds. So companies with positive green revenues, companies with 20% green revenues, companies with 50%, upwards of 50% green revenues. Of course, those portfolios upwards of 50%, they are smaller and smaller in terms of number of stocks, right? Because there's less and less companies that have achieved those high numbers. What we find is similar to some of the FTSE green indices, that there seems to have been a takeoff in the returns of these companies. Now, the results don't line up perfectly with this Paris story, because Paris occurs, right there, and the takeoff of green revenues I showed you was happening in 2026. So it might have taken some time for investors to process this. Most of the results seem to be coming post 2020. Now, this is around the EU Green Deal. But what is interesting is the results are not actually in European stocks. So maybe the regulatory push is not perceived to be value enhancing by investors, but actually the results seem to be concentrated actually in US stocks, and a large part of it driven by one stock, which is Tesla. So in the paper, we actually do all these robustness checks. What happens if you remove Tesla, etc. So yes, there is still a result if one looks into the high green revenue companies, even if you exclude some of the most extreme ones like Tesla, whose market capitalization, of course, grew tremendously and started dominating that portfolio, since this is a value-weighted portfolio. We also conduct some tests that are equally weighting, so we try to reduce the weight of these extreme observations. But the question academics would pose is, well, is this really green alpha? Or could this be driven by other things, market size, value, or could this be all growth companies, tech companies, momentum, profitability, investment, other factors that, as an asset pricing toolkit may use to assess if it's been, overperformance or excess performance, or has been just consistent with the characteristics of these companies. And here then the evidence of green alpha then becomes more limited. So I'll show you some of those that evidence, but again, refer you to the study if you want to see more details on that. So the way we do that is we actually form this long short portfolio of the green minus legacy companies. So, but we go long those green stocks, those stocks that have over 0%, 50%, 80% in terms of green revenues. And then we short the legacy companies that have no green revenues. And what we find is there's some positive alphas that tends to occur only post-Paris, and only for companies that have more than 20%, and companies that have more than 50%, and companies that have more than 80%. post-Paris, which is in orange here, versus in not observed pre-Paris. And these results are stronger in the US, as I mentioned before, but also for companies that had those green patents that I showed was a key driver to make the transition, and companies that have higher institutional ownership, as we showed was supportive of the green transition. So that's it in terms of this study. It's a very active literature here. Again, leave you some references on green taxonomies, EU policy frameworks, the greenium, this discussion of whether you should observe or not green stocks outperforming. So I'm going to conclude, and here are the main messages of my lecture. ESG 1.0, many institutional investors, ESG investors align their actions with their principles, but you should be aware of greenwashing. Number two, ESG 2.0 says, and that is, ESG 1.0 would be based on ESG scores. ESG 2.0 is more targeted towards climate and carbon footprints, carbon emissions. And even if climate conscious investors walk the talk by greening their portfolio, this may not be helping to achieve that broader ESG goal of greening the planet. The last study I showed you is, I would call it ESG 3.0, which is not focusing on the ESG scores or the carbon footprint, which a lot of this is about conduct and risk management and backward-looking measures, but more forward-looking measures in terms of the green transition. And what we show is some acceleration post-Paris, but relatively small still green economy, which leaves open the question whether the green transition is happening quick enough. Many other open questions for future research. I leave them here for the researchers in the room. And I just wanted to, if I may, speculate a little bit about what ESG 4.0 might be. If I may, is we're sort of in this verge of two industrial waves here. The AI and artificial intelligence and saving the planet, the clean tech. And it's not clear, I think, it's very much what we should be working next would be, whether this AI can ruin or save the planet, to not be very academic about this, whether, is it accelerating the energy transition, or is it actually hurting the climate commitments, for example, by tech companies? Are investors really, switching from ditching climate tech for AI and, all things that are, of course, happening. So with that, just to close, some advertising, as Yusha pointed out, we organized this PRI Academic Network Public Lecture Series. So I recommend the next ones. And here are also the details for this year's in-person PRI Academic Conference, which will happen in person in São Paulo. So with that, and that reference to Brazil and my native tongue, I'd like to say muito obrigado. So thank you for everyone. I'm looking forward to the conversation with Stephen, who has a wealth of experience in this and very much enjoyed his own work on this, and taking also, of course, audience questions via the Q&A. So thanks again.
Thank you very much, Pedro, and obrigado. I do know the words. Yes, so I agree it will be great fun exploring the potential synergies between sustainable investment and AI. So we may talk about that later, or maybe offline. So now we transition to the Q&A session. So moderating today's session is Stephen Beer, Head of Responsible Investment, Strategic Relationships, and Integration Strategy at Legal and General Investment Management, or LGIM. So Stephen is a pioneer in bringing global mining chief executives and church leaders together to work out the sustainable transition of the mining sector. Currently, Stephen serves as the chair of Church Investment Group, and he also is a member of GFANZ, so Glasgow Financial Alliance for Net Zero, and NZAM, Net Zero Asset Manager Initiative, two leading collaborative initiatives among institutional investors on green transition. So hence, we are very looking forward to him sharing his reflections on this topic as an expert practicing green transition in real life and helping us better connect academic insights with field evidence. So Stephen, over to you.
Thank you very much, and thank you, Pedro, for an amazing lecture there, extensive tour de force, and thank you for the paper as well that we read beforehand. And again, thank you to the organisers for arranging this. I think it's so important that academics in this field and practitioners get together and have this dialogue. I think it really enriches us both. And in the investment world, we certainly need we have different types of rigor, I think, in the investment and academic worlds, and we could certainly in the investment world we can learn from the academic rigor that we have here. So thank you. So, friends, what we thought we'd do is Pedro and I have a brief sort of chat around some of the themes, and then we'll look at the Q&A. Thank you so much for sticking the questions in the chat. We will look to address. We may not be able to address every single one, but we will look to address as many as we can, and also we'll make a note of those that that we haven't addressed. So, Pedro, thanks again. I suppose as an opening question, you know, how did you get that surveying the scene of the progress of ESG 1.0, 2.0, 3.0, etc., or from, if you like, the screening all the way through to sort of intense engagement? Was that an obvious roadmap that you could see? And I was also going to say, impressed that, you know, that we've got green revenue data going back to 2008, so you could see it before and after Paris. But was that an easy roadmap to see, or did you have to kind of make a judgment about, well, where we are on this journey and where we've come from?
Yeah, great question. So I think about ESG 1.0 and ESG 2.0 essential before we got to ESG 3.0. In a way, and ESG 1.0 was sort of establishing ESG and as a key consideration for investors. So metrics like ESG scores, they were, you know, essential, I think, to begin the conversation of how do we start measuring those things. There was a lot of learning and some pushback and greenwashing, as I illustrated. ESG 2.0 would be more on climate change. So the most important E, as I said, in ESG, metrics like carbon footprint and finance emissions. So trying to isolate which companies would be most important to engage with, like with the Climate Action 100 efforts there. So we sort of had to, you know, all that. As I said, greening your portfolios is not enough, and you know, and starting to push the conversation towards investors to engage and go for real impact. So the 3.0 is the green revenues, as you highlighted. They're hard to assess and they're debatable, of course. There was in the EU, there was this task force, this technical expert group to inform itself by science and scientific and engineering knowledge, so we could identify those products and services for the green transition. And so the question is, you know, without the first two waves of like, what are the impacts, the ESG scores, you know, from the company to the environment, to the society, etc. And also with, you know, a heavy focus on the carbon emissions, we couldn't really then identify those products and services that are starting to come out to, you know, to make the, you know, society and the planet more sustainable. And so we got there, which we're now, and now it's a question of, is this big enough that we have enough of a green economy, and then is it investable for investors? So for academics in the audience, think about that ESG 4.0, like, because it is a dynamic, we may not, you know, the solutions that were important in the early stages of the green transition, you know, stop being less important later on. And we really, after this overall overachieving real world change. So what is the, you know, what is the next thing? And for the people in the industry practitioners in the audience, just what other data should we be looking at? What other questions should we be posing ourselves as academics? So I think, yeah, so in a nutshell, agree, ESG 1.2 and 2.0, I think would be essential before we got to 3.0. But of course, there's still a lot to, to tackle into the next stage.
Thanks. And I was wondering, as I was thinking about that, whether, given that my career in responsible investing started in 1994, whether that in some way meant I'd been living in some prehistory in your timeline. But I don't think that's quite true. Certainly, I've seen that evolution of ESG being quite a bit in that kind of ethical or values-based world to some degree, but not always even then exclusively. So there would be a sort of consequentialist approach as well. So when one was engaging with companies, so you might say, I believe it's right, inverted commas, and a value that companies address, certain environmental concerns. But in the dialogue with companies, depending on the perspective it's coming from, one would also be thinking about, well, but the consequences of not doing this moral or ethical thing are material in some other way too, and therefore you probably should address them. And where that evolved is certainly in the UK, it felt to me was that then the concept of reputational risk was brought in, sort of more commercially, to sort of think, well, okay, if you don't do X, Y, Z, then there might be some reputational risk which then affects your ability to operate in some way. And so the argument came that way, and then it was a bit later. It felt to me, consistent with your timeline, that sort of a more focused approach on what might be materially, financially at risk here. And of course, from a point of view of a universal owner, that gets thought of as well, which you touched on in terms of, well, what are the systemic risks as well as the systematic risks in the market? And what's the difference between the two? But is there something I can do, or investors can do materially for their clients, and that addresses the systematic risks, the issues that affect the whole system we're in, whether it's climate or even some would argue the kind of social issues around it. I should say that if I'm expressing any views here, that they're sort of quite personal ones. Just to sort of broaden it out, and then I'm actually looking at the Q&A as I ask this as well. You have to, thinking about this academic, you've got to go somewhere to kind of work out where, how to measure, if you like. So I guess going to ESG scores is a good place. But you've talked there about that evolution of the environment that we're in, and I think certainly in your paper as well, what sustainable investment means is an evolving characteristic. I mean, do you think that, what do you think the role of public markets versus private versus, well, I suppose sort of state, semi-state parts of the economy would be there? Can you see an evolution there from your point of view?
Yeah, great question. So before answering that question, I agree with you that, we've had this evolution. So I've learned from you and others by your thinking, and what the ESG scores and the carbon metrics and this green revenue sort of the 1.2, 2.0 and 3.0 is sort of setting out this ESG goals and thinking out more a risk mitigation sort of approach to like the positive societal contribution. So are you actually helping? The ESG goals, some investors may still be focused on performance. That's their fiduciary mandate. Some are, thinking about it from managing risk. So by going into green revenues, what we're trying to show is like actually that last part of contributing to the solution or to the societal. So not just risk reduction, but the evolution. So on that domain, as I showed in the carbon emissions, there's a lot of emissions that reside outside of public markets. So the state sector, the state-owned enterprises, of course, are huge, particularly in the global south and many economies around the world. There's also, privately held enterprises, of course, and then the public sector, as I was showing you, a lot of the, there's a lot of decarbonization of the, let's say, FTSE, top companies or the MSCI equity companies and so forth, much faster than the other companies. And so there's a risk that the emissions can be pushed out, from public markets to private markets. So I'm only starting some work on this, but we were looking specifically into the energy generation of who's transitioning out of coal faster, decommissioning, coal plants, who's ramping up faster in terms of renewables, and who's still investing in nuclear and so forth. And it's interesting that these different players, the public sector, the state-owned enterprises, the private, including private equity, infrastructure funds, and so forth. And then the publicly listed, companies play a different role, and also different geographies. And so companies from Europe versus companies from the US and, and China and other markets. And so it's very early stages to give you those results, but I think it is, what we should be looking is like, what is the role of, these different players, not just the public equity markets, which we examine mostly, we look where the light is, if you like, in terms of academic research, because we have a lot more data there, but there might be a lot more happening elsewhere. And it's good to understand if, what's happening in the public equities spills over to the private or vice versa. It's just pushing things to the private space, and to get that system level, assessment of what is the amount of progress here. So yeah, for the authors, for the academics, this would highly recommend working on those topics. But for the practitioners, help us get the right data to answer those questions, because it's much harder to assess, those private markets.
I suppose in some ways that plays a bit to the sort of the tilting divestment perspective that you referred to there, because the sort of public markets aren't a closed universe. There are obviously, yes, there's state actors in there, but there's also those private markets, and we see that sometimes divestment of assets by companies that might be fossil fuel intensive assets being acquired in private markets, if you like, in the unlisted part. So that would be a very interesting area to kind of understand, and I guess that will play into, and I see a question on, divestment affecting cost of, to the extent it affects cost of capital in some way. That must be quite a key part of that discussion.
And I highlighted some of the papers there on the cost of capital channel. Just highlight a few papers like the Hartzmark and Shu paper that's trying to figure out if it's divestment by raising the cost of capital of brown companies could actually make them more short-term sighted, and and not make the investments that are more long dated that move you towards green, but actually increase pollution, because you focus more on the brown, those that actually deliver cash flows much sooner. And they are worked by Alex Edmonds. That was more on the theory of like the value of staying investing and tilting in and rewarding those companies that are making those improvements, so staying invested. The question, of course, it takes quite some time, and in one of the decarbonization paper, we look into like only 2-3 years, and that may be too short in this effort. So a couple other work there, and if you go back to my slide 18, there's for those academics in the audience, then it's interesting to to see what are the issues raised by those. But generally, yes. So I feel like there's been a lot of tilting away, and that can just, as you said, Stephen, to push these things away from public markets. So more disclosure, more public pressure, regulatory pressure on publicly listed companies could push those things towards the private market. But again, we have very limited data on those, so it's somewhat hard to fully assess.
Thank you. In your lecture, in your paper, you have what seems to be potentially, well, it is a very interesting finding, and I want to make sure I'm going to draw the right conclusion from it. It's that finding that the influence of the US versus the US versus the EU, not influence is the wrong word, but I mean the driver of or the link to innovation and green revenue growth. You're not seeing an effect in the EU, which you ascribe maybe to the sort of overall, I think, wider regulatory environment on sustainability. Whereas in the US, it is apparent. What conclusions can we draw from it, and what conclusions should we not draw from it, because we don't yet have, because we'd be taking it too far? Because one could say something about the innovative nature of US economy, or even just innovation generally, and the encouragement of innovation being a better maybe for investors than a regulatory environment. And yet, of course, your study is highlighting a sort of, not a regulatory watershed moment, but certainly a sort of global public intention, policy intention moment of what happens, before and after the Paris Agreement.
Yeah, and that's the way I think about it as well, that it's not just the regulatory shock that investors may anticipate post-Paris, but the salience of Paris was elevated, of climate change was elevated with the Accord. Walking into the Accord, there was a lot of perception that this would be another failed Accord, and of course we're now talking about withdrawal from the Paris Accord here in the US. But it was really like it changed the conversation. So even what I think about it in the US would be, even if there's no like federal level commitment to those NDCs and so forth, there's still like more regional or state level, city level, and more importantly private level opportunities and risks that investors became aware, and a lot started happening there. So the challenge might be, yes, the US is, we're now seeing it with the AI, more innovative, and before, in clean tech, there's a lot of innovation also coming out of here, but there can always be downsides. So, not to name Tesla's, just talk about Tesla, but Tesla is a great illustration of like, you could have green revenues, but which the company does, but then like as you surely some people are aware, the EU taxonomy talks not just about measuring green revenues, but also green sourcing, so green OPEX, and then green CAPEX, and it's important to take a wider lens, not just of whether the product is green in some way, but upstream and downstream, right? What is the total impact of that? So how you source the minerals that go into the batteries, how do you dispose of the batteries, how do you charge the cars that you're running, and so forth. And this is just to give you an illustration of a company that really took off, and came out, really moved the car industry equilibrium, completely shifted the car industry. Incumbent companies, including many from Europe, were much slower to to do so and are somewhat struggling with that transition themselves. But you also have, have Chinese players, BYD and so forth, or on battery technologies, CATL and so forth. So a lot of Chinese technology also disrupted, the European technology. So to your point of what my interpretation is, it's more free markets here in the US. And a lot of investors don't feel constrained as much by the purely regulatory push. And so maybe there's more teasing out of which companies are actually adding value to shareholders while they're contributing to the transition, versus places like Europe where it's more pushed down by regulation, and that can come at a cost to well, it could be neutral or net negative to the shareholders. But again, we've had so many subsequent shocks, as I mentioned, war in Ukraine and so forth, that this needs bigger examination. And yeah, and I'm as I referred to it, now we have AI, so that would be yet one more to consider.
Thank you. We're into our sort of closing 5 minutes or so. For maybe we've got an opportunity to get a couple more quick questions in, and trying to encompass again some of the questions I've seen in the chat here. How should we, in thinking about your paper and just generally when we're studying this, how should we distinguish between, or ensure that we distinguish between the returns to investors, say for example, being exposed to companies with a high proportion of green revenues, from the role of investors in promoting that transition and leading to change and development in companies? I mean, that's a reflection which isn't quite straight on this, but I certainly do feel that in this field as an investor, a lot, not all, but a lot of the debate can be clarified out there by a real focus on what the objectives are of any given, whether it's a fund or whether it's what we're discussing on ESG, or what's actually being, what are we trying to achieve, whether it's performance uplift or some investors a change, or systemic risk mitigation, for example. So how should we ensure that we know what we're talking about?
That's a great question. So it's about like me asking you, Stephen, what you think, or you reporting into systems like the PRI's, reporting system like the one I examined before, and of course, and then us sort of getting a better pulse on exactly what are the declared goals, what are the strategies, having more granular data to tease out what investors are actually incorporating ESG. So that, again, it's a call for data here. So the PRI is a great initiative in the sense that, this reporting data sort of illuminated my own research onto, like, are you screening? Are you doing ESG integration? Are you doing engagement? But then, for example, on engagement, the data is not granular enough to know which companies have you talked to, what meetings, how all your voting records. Some of it is becoming more available, but it's harder to assess. What other, and we did measure collaborative initiatives like the CDP, climate action, PI membership there. But yeah, so it's just having more a lens into all these different strategies of like building, screening your portfolio, integrating how exactly are you integrating, but versus engagement, and then studying, those sort of portfolio strategies or management strategies versus the portfolio engagement strategies, and seeing how they play out in different markets and at different points in time. But the data is much weaker, I would say, on the engagement side of things, because and I should warn, that this can only, that BlackRock article I shared in the Financial Times yesterday was, there's, for example, we sort of rely on a lot of public filings like the 13Fs and the 13Ds and the 13Gs in the US to tease out who's more active and more passive in terms of engagement. And a lot of ESG may now be perceived as not passive anymore. And that may, may contaminate even more this discussion of what is observable from the filings and from what's in a public record, and what is possible for investors to share. I fully understand that investors would have a lot of hesitation to share as well. But yeah, so thanks for engaging in this conversation and being here with and our efforts in the PRI Academic Network is to bridge these two worlds so that we can actually better get to an answer to those questions.
Well, thank you very much. We're at the end of our time for Q&A. I want to recognize those questions we haven't been able to address directly. Some were detailed, one or two were perhaps taking us into other areas of ESG, which would make fascinating this conversation. I really wanted to talk about one or two of those. But we're at time. And so thank you again for your lecture and for this discussion, and I'll hand back to our hosts.
Thank you.
Thank you so much, Pedro and Stephen, for the very enlightening and engaging discussion. So I think it is a lot of things for food for thought, and I'm already thinking about how to better connect different disciplines together, like revenues from accounting and then investment from finance, and then we also have other disciplines such as strategy and maybe legal perspective. Yeah. So, so to our audience, thank you so much for being part of our second lecture for the NBS-PRI Public Lecture Series. We are so grateful for your presence and engagement and all the very fantastic questions in the chat box, and also the Q&A function. And we hope you have gained valuable insights and are inspired to further explore this area. And a heartfelt thank you to the organizing committee from NBS in Singapore, PRI in UK, and ECGI around the world for your great work and dedication in the smooth operation of the series. This collaboration has been a true pleasure. So our next lecture will again look at sustainable investment, but from a law perspective, delivered by Professor Madison Condon from Boston University School of Law, and moderated by David Alfrey from Addershaw Goddard LLP in London. So this lecture will be hosted online via Zoom on 5th of March next month. We look forward to welcoming you again, and please stay tuned for updates via our website and social media. Before you leave this virtual room, please take a few minutes to fill out the feedback poll on Zoom, and we really appreciate your honest feedback to continuously improve this series. So this marks the end of our event today. Thank you once again, and hope you have a wonderful rest of the day.